Hi, Richard Hemming here, founder of Under the Radar Report. It is great to be back. The markets have never been more exciting than they are now. This week, we had a 25 basis point cut from the Federal Reserve. Big news, which the markets were eagerly anticipating. The thing is, we initially saw selling, and then that was followed up by buying. So the markets are very skittish right now. They're trading up record highs. We saw the Russell 2000 and NASDAQ, the S&P, the Dow Jones, all hitting record highs. What does this mean? This means you need to be recycling your hard-won gains. You need to be looking hard at your portfolio. And this week, I'm going to show you how you can do this. And I'm also going to give you some treats in terms of some stocks where you can invest in value, because that is the key. It's taking risk off the table by taking profits and then reinvesting in value. That's how you make money. Take advantage of the momentum, people. At the start of the month, I said we've been taking profits on some pretty big performing stocks, namely big caps, Qantas, Super Retail, Downer. We've been taking profits on those stocks, and we've seen some weakness, particularly in Super Retail, where the CEO left. So basically, we've been taking profits on big and small caps, but we've seen particular weakness in some of these big caps where the news isn't good. Why? Because basically they're priced for perfection. The momentum that has driven these stocks up means that they cannot afford to make any mistakes. So we've been taking profits in other stocks, and you need to check out our website to have a look at where. And also we've got a lot of buying activity. And the good news is this research rundown gives you the ready retina on 90 plus small caps. So you can see the 28 plus buys that we've got. You can see the holds and you can see the sells and take profits all in one place. It's a really great one-stop shop. So how do we judge where to take profits? How do we do that? Well, when a stock trades on big multiples, typically higher than its average historical multiples, you've got to question. You've got to question very carefully whether that multiple is sustainable, because you get two areas basically that promote stock appreciation. One is earnings growth. The other is multiple expansion. So when you get lower earnings growth but multiple expansion, you've got to really look hard at whether those stocks can sustain, whether the earnings can sustain that kind of growth to justify the multiples you're paying, because the risk gets higher and higher. Multiples cannot expand indefinitely. Trees do not grow to the sky. So one thing we look at is sustainability, but the flip side to that is when expectations are low. So when expectations are low, the company doesn't have to do that much to impress the stock market. So what do we look for? We're looking for stocks that are on lower multiples. So you get the earnings growth, then you get the multiple expansion. That's the double whammy. So you get the flip side of that. That's what we're trying to do. We're trying to get out of stocks where expectations are too high and get into stocks where there are low expectations. So let's talk about two stocks where we've been buying because expectations are low. One stock we've been buying recently is South32, S32. This is a big cap. So this is a blue chip company that was originally spun out of BHP. So they've suffered recently on, I guess, uncertainty relating to commodity prices. But the thing is, the commodities that they're in have actually been going up. More to the point, these are commodities that are going to be in more and more demand. They're known as critical minerals. So you cannot get this mixture of critical minerals anywhere else. So we're talking copper, we're talking aluminium, we're talking zinc. This is one of the world's biggest producers, and it's got big growth down the track from big investment. It's really worth reading our research. This one is worth investing in because it's not going to go broke anytime soon, and you've got production growth, and you've got that being supercharged by increasing commodities prices. The second stock, which you've also probably heard of, is Kogan, the online retailer. Well, this stock has been on the nose for various reasons, but basically the big reason is that they're trying to transform the company internally. So this often involves a bumpy process, and in the last result, margins got hit by some IT problems that they had in Mighty 8, their New Zealand operations. But the bigger point is the ambition of Rosalind Kogan and his team is impressive. Basically, they want to increase earnings margins from 7% at the moment to 20% over time. How are they going to do that? Well, they're selling almost loss-leading or lower margin products to get people in the door, and then they're getting those people to go into higher margin platform services businesses. So we're talking about insurance, we're talking about telecommunications, we're talking about the delivery platform, Kogan First. So these margins are much higher, plus they're recurring. So there is great potential at Kogan. There's been a couple of hiccups, but that's to be expected. You're investing for the long term. That is the advantage that we as individual investors have over institutions. So look, there's always risk. There is always risk, but you don't have to be paying too high a price for that risk. Being a value investor as an individual is the only way to make big returns and to sleep easy. Look forward to talking to you next time.